Mm, okay, no audio on the video commentary. Okay, can you hear me okay? Yeah, I think, okay, James, thanks for that, James. Yeah, okay, that's great. Thanks, Asanka. Yeah, okay, lovely. I think we're done now, and I've got everything set up my end, so we can start getting looking ahead to the session. Now, we've had a lot of movement recently, and we saw some quite big events yesterday with Fed Powell's speech, which has given us a little bit of movement, which has been helpful. So let's start off first of all with our dominant currency sentiment pair. Now, our dominant currency sentiment pair for the session is the Australian dollar Japanese yen session. Now, the reasons for we're expecting downside on the Australian dollar Japanese yen pair from any return up to that 69 handle. Now, if we just take a look at the data we had overnight from Australia, we had noted in the risk event report that because of there'd been some better data than expected from Australia recently, and that was partly to do with the cutoff time for looking at March's data. So April's data was expected to actually include the full kind of hit of the coronavirus 19 lockdowns. So this was anticipated to potentially show some weakness, and it did show some weakness. We saw that the expected was 575,000. The actual came at 594. Now, I know these are still huge employment falls, and obviously it's a tragic situation. However, just in terms of market reaction, that in itself wasn't necessarily too off the mark, because we had minimum expectations of 750,000. So this was a miss, but it wasn't a massive miss to the downside. However, what was making that data point worse was the participation rate. See, with the participation rate falling to 63.5%, it means that less people have participated, but more people are showing signs of falls in employment. So in other words, the actual data would most likely be much worse than that. And the unemployment rate is obviously affected by that participation rate. So taking that Australian data as a whole, that was a negative for the Australian dollar Japanese yen. So the Australian dollar was sold off on that weak data. Now, we also have Japanese yen weakness. Now, this Japanese yen, Japanese yen strength. Now, this Japanese yen strength came from Fed Powell's speech yesterday. He said that US economy was going to have weak growth, stagnant income. He talked back the idea of negative interest rates, and that hit equity markets strongly yesterday. And so we've seen downside in equity markets from Fed Powell's speech yesterday. Obviously, he gave quite a bleak prognosis. We've also had US-China tensions re-emerging. Even just before this webinar, we had some, really quite spicy comments from Chinese Global Times editor saying, his article, war will occur. He says two countries increasingly dislike each other, conflicts are rising, therefore risk for a military clash is increasing, but meanwhile they both don't want a war. Now, obviously, neither China or the US want a war, and US President Trump has not been a president that has gone to war. So, you can see it's not in his kind of nature to want to start a war, despite his very heated rhetoric, which many people find very strong. He hasn't rushed into military conflict. So that's why the market wasn't strongly reacting to this, because obviously neither China nor US want a war. It couldn't really be a worse time. However, this is negative for risk, just reminding the market about the US and China conflict, that really it is growing, if anything. So we've seen falls in the equity space. Commodity markets have been relatively flat to rising for the oil market. Oil markets have got their own positive sentiment recently, with Saudi Arabia cutting production by 1 million barrels. Iraq's been talking about adhering to the production cuts, and that's been sort of supportive of oil. But obviously, wider term, the big term picture still remains as less demand. So any sort of spikes up should be treated with caution. And we've seen sort of downside in copper, flat platinum, a little bit of rising in gold, a little bit of rising in silver, just gently rising to the upside. And on gold, we've just sort of broken out of that ascending daily trend line, which you can have a look at if you would like to, because that's a significant break. But in terms of our dominant currency sentiment, we have seen some yen strength coming into the market. We've also seen that US dollar strength coming into the market. Now, the US dollar strength has been on Fed Powell's explicit denial that the US does not want negative interest rates. So at the moment, negative interest rates are not on the Fed's agenda. That boosted the dollar strongly. We've also had a very interesting comment from President Trump, who boosted the dollar index a little bit further today. He says it's a great time to have a strong US dollar, and I feel strongly that we should have negative interest rates. So US President Trump there wanting both strong US dollar and negative interest rates. And that's a hard trick to pull off. But it's interesting that President Trump would like that. That's a case of wanting your cake and eat it, because obviously if negative interest rates do come in, that's going to weaken the dollar. So he's asking for he's asking for a one-ended stick, if you can follow the lack of logic there. So that's President Trump, the way he's seeing things. He wants the best of both worlds, literally. So we've got this scenario of a risk-off market. We've got weakness for the Australian dollar after the poor jobs data, weakness for the Australian dollar because of the risk-off tones, strength of the Japanese yen. That's why we maintain a selling bias from this 69 region. Alongside the Aussie Japanese yen, we also have the New Zealand dollar Japanese yen. Now, this pair can also be considered for shorting up at that 64.1720 level. Now, the reason for the New Zealand dollar weakness has been the central bank of New Zealand Met, the RBNZ, and the RBNZ basically kept interest rates the same. They increased their bond purchase to 60 billion New Zealand dollars. That was all expected. But what really resulted in the strong selling of the New Zealand dollar was this very simple explanation that the RBNZ are essentially warm to negative interest rates, and the deputy governor was telling New Zealand banks to start preparing for negative interest rates by the end of the year. Okay, so that is why we have a negative bias on New Zealand dollar Japanese yen. So both of these, Australian dollar Japanese and then New Zealand dollar Japanese yen pair, obviously it's depending on this negative risk tone. If we get a positive risk tone developing, that would negate this outlook. If we had some positive US-China comments, so, and don't write this off, you can imagine that, President Trump saying, him and Xi get on great and they're looking forward to doing a fantastic deal. This is the way that President Trump tends to, some call it negotiation. He blows very hot and very cold within 24 hours sometimes. So just to be aware that, risk tone is very sensitive. And the other risk factor we've got for this will be initial jobless claims that's coming out later this afternoon. I'll cover that in a moment. I'll just hold that for now, just remind ourselves that that is a potential risk. Now, the other potential upside that we have is any return back to this 1.0700 handle on the Aussie New Zealand dollar pair. Now, although we had the weak jobs data out for Australia, we still have a divergence between the two central banks. So the RBNZ is willing to go to negative interest rates. Australia has said it's reluctant to go to negative interest rates. So that divergence, we would still expect buyers from this 1.0700 handle from any fallback down, looking to take profits up here at the 1.0 750 region. So there is potential for upside there. So that's worth keeping on the radar, although prices sort of hovering towards the highs, but certainly it's not worth going in at the highs, particularly with the weak Australian jobs data that's come out recently as well. Okay, so let's look now at some risk events that we have. So we'll go forward into the current risk event. And the main event to be looking at is the initial jobless claims data out. Now, although the initial jobless claims are expected to be very high at 2.5 million, it's just worth bearing in mind that we're starting to see the range of expectations narrowing. So it's between 2 million and 3.1 million. Now, if you just look at the kind of the bar chart of the last US jobless claims data points, we see that the trend is to the downside. So obviously these are, new jobless claims each week, and obviously that falling is a good indicator. So therefore, if we get an unexpected fall below 2 million, that could be positive for risk on. So just the thing to be aware of here, if we get initial jobless claims, if we get a reading below the minimum expectations of 2 million, then that could prompt risk on flows. So Aussie strength, New Zealand dollar strength, CAD strength, oil strength, potentially strength in equities, bond yields, and weakness in the US dollar. So just to remember, the US dollar has been acting as a safe haven. So the potential here is that you get good US data, but it results in US dollar weakness. So just to be aware of that, that dynamic is being played out at the moment. Now, if we get more than 3.1 million, so it's worse than expected, and even if we get something, something showing those nut figures going up even further, that would be negative, and that would result in risk off flows, and that would assist our current dominant currency sentiment bias, because we've got that risk off flow still maintained. So that would help a New Zealand dollar Japanese yen short. It would help an Australian dollar Japanese yen short, and it would most likely result in some dollar strength. Okay, so we'd expect to see some further dollar strength. Just to be aware, there's a lot of talk about negative interest rates. So keep your squawk on and alert to any talk about negative interest rates. There's a lot of concerns about US-China relationships, and there's also concerns about COVID-19 second wave of infections. The key thing to remember with these COVID-19 outbreaks is that historical pandemics tend to operate in waves rather than in, let's just pull this across, rather than in one-time event. So this is the Spanish flu. I shared this on Tuesday. I'll just share it again for those of you who weren't here. You see the first peak was 5 deaths per 1,000, and the second peak was just shy of 25 deaths per 1,000 people. So there was a jump of around 5 times. So the second peak was almost 5 times worse than the first peak. Now, obviously there's differences between the Spanish flu and COVID-19. So the Spanish flu primarily impacted people in their prime of their health, in their 20s to 40s, and some of the social distancing measures were questionable. So I was reading wrong report that people were encouraged to smoke in factories because it was believed that the smoking would kill the virus and those kinds of things. So medically we have improved, but don't be deceived, because this is just indicative that pandemics tend to operate in waves. You get these peaks. So you can see here in the year 1918 to 19, we had 3 major peaks, and the first peak was not as bad as the second and the third peak. So that's why there are some investors very nervous about any further upside in equity markets, and that's why there's a lot of focus on future earnings and consumer behavior. So just to be aware of that kind of dynamic that is going on. Okay, I'm just going to check that I've covered everything that I want to. Yes. Yeah, I'll just leave it on our dominant currency sentiment pairs. Okay, that's great. So I'm going to now go and work through the questions and answers that we have. First of all, Rolando, yeah, Trump wants the US to be Switzerland on the comment about strong US dollar and negative rates. Yes, Rolando, I hadn't thought of that, but you're right. Yeah, he does want that. Yeah. Hi, Mark. What is the short-term view of oil? Got caught in a short just before Saudi cut announcement and may have to cut to a not insignificant loss. Okay, yeah, let's have a look at oil. Yeah. Now, let's just have a look at oil. Yeah. Okay, just see. I'm just gonna put some pivot points on here to see if we've got any key resistance that we might, let's have a look at it. Let's have a look at it properly just to see if there's any pivot points that are key here that may work as resistance. Okay, so we've got some support around this 1900 level. In terms of the fundamentals for the oil market, we've seen those extra cuts from Saudi, which has boosted the markets. We've also seen Iraq willing to adhere to production cuts more willingly, and we've seen this gentle bid in oil. It's a tough one, Mark. If you're caught short and you're wanting to get out of that, if you put a gun to my head, I would say that oil is heading low. We've got the contract expiry coming up shortly. And if you remember last time we had that contract expiry, we saw that huge sell-off in the oil market because people didn't want to get caught holding oil into a contract end. So we saw May's contract selling off strongly. So I think you've got to work out which contract you're holding, Mark, whether it's June or July. And you've also got to work out if your broker might suddenly jump your contract on. I did hear news of some brokers that are saying that they reserve the right to just bump traders onto the next contract, which wouldn't help you if you're short, and also you pay that heavy rollover. So just check your contract expiry. I think it's a few days. It's either the 17th or the 21st of May. I think it might be the 17th, but you have to check that, Mark. Put a gun to my head, I think actually the demand hasn't crept back. You've still got airlines just sat on the runway. You've still got cars sat on their drives. You haven't got that huge demand. So you would expect some more downside in oil. But on the other side, you're seeing, production cuts, oil market trying to stabilize. So it's a real tough call, Mark, especially if you're underwater and you're caught in a painful short. So I think, at some point you got to say when you're going to bail. Just looking at the technicals here, we have this overhead resistance that price is just moving into. So just one thing to look at is the overhead resistance, and potentially just looking at that 20 just above the ADR high of the day. That might be a line in the sand. If I was in the same position and I was thinking, where am I definitely going to get out? Stop the other side of that level, because if you get a break above and a close above that level, then you might get a retest and a move up higher. Although put a gun to my head and I'm expecting this to go down, and you don't know if you're going to get negative rates again like we did last month. So I hope some of that helps, Mark. I'm sorry I can't be more helpful on that. Hi, Rolando. What's the rule of thumb to trade future indexes? How do we trade the S&P or FTSE or DAX with the information we get every day? Thanks. Okay, well, obviously trading the indexes is different to trading currencies. And with the index, you're obviously trading a whole spread of a country's companies. So one way of trading them, you can trade them in that same risk on, risk off tone. So one trade that I took towards the start of the coronavirus outbreak was the Nikkei 225, just as it was breaking out of this area here. It was yeah, it was just trying to remember what date it was. Yeah, it was just in January, I think. Yeah, that was it. It was yeah, that's it. I took a trade on the 23rd of January, shorting the Nikkei. And that was just as the coronavirus was starting to really break out. And it was at that point I thought, oh yeah, this is going to be serious. So this is going to be a risk-off sentiment. And I just shorted the Nikkei on that risk-off sentiment. So one way of trading the indexes is you can just trade them as you would a currency. It's the same conventions. You use, you know, a mini lot, micro lot, standard lot, same conventions of trading, and just, you know, you're using the same technical. So I remember I was looking at potentially a retracement up to here was what I was looking at on the day on the 23rd. I just remembered it here, 23rd, you know, 22nd, 23rd. I was just looking for a retracement up to this level, because I'd sort of reasoned that, hang on, this is the post, above here is post-viral outbreak level. So I was looking for any retracements for shorting, and just using the same principles as you use for currencies, but it's just one-dimensional because you're not pairing it with anything. So I don't know if that's helpful for you, Orlando, as a rule of thumb, but that's just an example of a trade I took on the Nikkei. And obviously you can do the same with the FTSE or the DAX, depending on what impact you know, nations are having. So you could trade an index on, you know, how bad a COVID-19 outbreak is. Ruben, yeah, hello. Swiss National Bank wants to sell Swiss francs to keep the exchange rate at a lower level. How do I generate these sales? Who are the buyers and what amounts move during a day of trading? Thanks. Now, Ravinda, you can look at the site deposits for the SNB. So if you just Google SNB site deposits, you can see the weekly inflows or outflows of their currencies. So the amounts vary, and recently the amounts of euro buying and euro Swiss franc buying has increased for the Swiss National Bank, and there's been a lot of, you know, chatter around about, you know, will they defend the level again? What are they going to do? So that's the thing to look at there, Ravinda. Oh, Sajith, yeah. Do I think the SNB will intervene to put the Swiss franc down? Oh gosh. Yeah. Now, just have a we'll just have a quick look at euro Swiss franc. It's a good lesson to learn here. Now, the key thing to remember with the Swiss National Bank is that they've been here before. Okay, for years they said they were going to defend this 1.120 handle. You see this level here, 1.120? For years they were saying we're going to defend that level. So anytime price got anywhere near that level, traders were buying with huge amounts of leverage, Sajith, you know, 100, 200 levels of leverage, just buying off these levels and trading the spike above, okay, and making a lot of profit. Now that trade worked very well until it didn't, Sajith. And it was early January, I think it was around the 15th of January, that the Swiss National Bank, in a surprise move, stopped artificially holding up the euro Swiss franc pair. They stopped buying euros and they removed the floor. And that removal of the floor was this huge sudden move, and it took many traders out. It took out a hedge fund of $200 million I read about, took out some brokers because people were over leveraged. So the first thing I'd say to G, use this as a lesson that whenever there's no surefire bets in trading or investing. You know, it was a book by Charles Dickens called Little Dorrit, where in that book there was a man who was the investor of the age. He was the man of the moment. He had the funds to end all funds. It couldn't go wrong. It was brilliant. He was you know, all this kind of thing going on. Everyone invested their money into the fund, and eventually the fund broke. and everyone lost their money. This is a similar event that happened to the Swiss National Bank. Everyone said, the Swiss National Bank, well, they'll defend 1.20. You know, they've got huge gold reserves. The Swiss National Bank can do it. So this is a foolproof trade. Well, you can see what happened. So the first thing to remember, will the SNB intervene? They intervene now, but in a different way, Sajid. So if you look at the sight deposits, you can see the level of intervention that's going. So they just they try to nudge it up higher. Now, the Swiss franc getting higher and higher. If equity markets keep falling, the Swiss franc is going to get stronger and stronger and stronger. So the key thing to be aware of here is watch out for any talk of a level. So if they say we're going to defend parity, then that is a potential trade to do, but don't over leverage. So expect a move. At the moment, we're heading down towards parity, and we could well see a retest down at this level. So just to be aware of that, okay? And just to be aware that price can get volatile down there. So will they intervene? I think they will intervene. How they'll do it, they might use negative interest rates. So look for a surprise negative interest rate announcement that can see a sudden spike up in the euro-Swiss franc pair, and look for any talk of a level. I think they will do something, because when the Swiss franc gets stronger and stronger, it hurts their export economy. So they're going to do something. But the point I'm making is whenever they say they'll do something, okay, first of all, find out what it is, but don't over-rely on it, Sajid, because people made a bad mistake in 2015. And for some people, they never recovered their trading accounts or trading again, or, you know, it can have a very serious consequence. So that's a little health warning there as well. Yeah, that's great. Yeah, you're welcome, Mark. Hi, Nick. Could you go through the oil inventories released yesterday? I think I misread this as a positive for oil. How to interpret this oil inventories draw? Yeah, okay. So the key thing to realize, Nick, is whether you've got a build or a draw. If you've got a build of inventories, that means inventories are higher, okay? And that's negative for oil. If you've got a draw, that means there's less inventories, and that's a positive for oil. So let's just have a look if we've got. Okay, here, so this is the oil data. So crude stocks, you can see that this was below minimum expectations, 0.745 million, okay? So what you want to look for is if there's a build, if this number is higher than 7.5, that would be a larger build. If it's less than 3 million, it's a draw. In other words, there's less inventory. So this was a fall in inventory levels of minus 0.745, which is positive for oil. Okay, I hope that helped. It takes a bit of time to get your head around inventories, Nick, so don't be hard on yourself there. It's basically, the bottom line is if it's a build, it's more supply than expected. If it's a draw, it's less supply than expected. You should be able to work it out from there. Hi, Valda. Would US dollar lose its safe haven status with negative rates? No, Valda, I don't think it would, but it would lose some value in the short term, okay? But it wouldn't lose its safe haven status with negative rates. The US dollar is the most liquid currency, and so, you know, you would expect to see US dollar strength regardless of negative rates or not. Yeah, what do you think about, hi Dashabi, what do you think about CAD strength with extra oil cuts from Saudi Arabia and UAE? How long normally would it take CAD to strengthen? And also like to know about Euro CAD pairs swing position. Please give an idea. Yeah, thanks Dashabi. Yeah, now it's usually pretty instant. Usually when you're seeing like oil prices moving up, you'd also expect to see CAD prices moving as well. So it's usually instant. You can see here, we've got reasons. Look, this is quite range bound, the pair, because we've got reasons for US dollar strength and Canadian dollar strength. So the pair's just been flat. You see how they've been evening each other out. Let's just take a look at the Euro CAD pair. Okay. Okay, Euro CAD. We've got reasons for Canadian strength at the moment, which is weighing on the Euro CAD. So as long as oil prices are pressured, that should drag on the Euro CAD pair. We're also got broad reasons for Euro weakness, given the fact that German Constitutional Court is raising issues with the ECB. However, some of that's been downplayed recently at the moment. So bigger picture, we're expecting Euro downside. At the moment, we've got some CAD strength, so that is adding to that Euro CAD downside. The only thing that I would say to be aware about, Deshabi, is that actually the oil market is still quite, there's some large issues for the oil market. So if you just go back and just have a look at the chart. Hang on a minute, let me just take a look here at oil prices. You can see, look, on a weekly chart, you can see, look, the oil market's heavily sold off. So bigger picture, we've still got pressure on the downside for oil. So not expecting like medium-term and long-term strength in oil. At some point, you'd expect there to be sellers to rejoin this oil market, particularly as we're coming to contract end. So that's what my view on that, Deshabi. I hope that helps. So for an intraday trade, Euro CAD, that fits below, the dominant currency sentiments that we're looking at today: Aussie yen, New Zealand dollar, Japanese yen. Yeah, Sajith, that's it. You got it. Yeah, Yanko, I heard SMB intervening through US dollar Swiss franc. Mike Patson said that, former Forex Live moderator. Yeah, Yanko, all the Swiss franc pairs were impacted. And so you can look at the site deposits each week, Yanko, and you can see what interventions the SMB are making. Yeah, Owen, the long-term view for the pound is still bearish. Owen, morning. The reason is until we have an EU-UK trade deal, which is due to be arranged by the end of this year, and it still hasn't been arranged. Until we have that, the pound is likely to find sellers on any retracements. So long term, we're still expecting sellers on the pound. The UK has some of the highest COVID-19 cases in the world. We have, I think, the 4th largest number of deaths. We also have an EU-UK trade deal still to be arranged. So that still long-term view on the pound is still bearish. And there's even potential talk being around on the feed today about negative interest rates for the pound, which, obviously it hasn't been confirmed that they'll be there. But if we get talk of negative interest rates as well, that will weaken the pound. Hi, Grant. View on Euro Australian dollar and pound New Zealand dollar. I'm short on both, but I think they should come back. Thank you. Yeah, pound New Zealand dollar. I see why you were short on the pound New Zealand dollar. It's the tricky thing here is with the latest data point from. Let's just go back here. I'll just pull up the latest data point, rate decision from the RBNZ. So the problem you've got here, Grant, is you've got the pound strengthening against the New Zealand dollar because of the RBNZ's willingness to go to negative interest rates. So if the Bank of England don't go to negative interest rates and RBNZ do go to negative interest rates, then that favours upside pound New Zealand dollar. So that's the pressure on. So a key trend line to look at is just here on the daily chart. that'll be a key area to see some kind of reaction. If you're going to expect some sellers, you might expect some short-term sellers coming in there, and then maybe a slight pullback. I wouldn't like it longer term now because of the move from New Zealand RBNZ grant, the fact that they're willing to go to negative interest rates. So although the outlook is still bearish for the pound, if RBNZ go negative interest rates but UK don't, then that's going to muddy the waters on that pair. So that's what I think about that pair. Euro Australian dollar. This one is, I'd be more optimistic on this one in terms of the outlook. We got the, between the two countries, we've got Australia is coming out of lockdown much more quickly. They've got a lot fewer cases, COVID-19 cases, than Europe. So you would favor Australian dollar strength going forward. The spike up in the Euro Australian dollar today was on that weak jobs data out of Australia. So I still, if you put a gun to my head, I would still have a bearish bias Euro Australian dollar. But obviously you've got to keep an eye on the Euro. Got some German manufacturing data out next Friday. Keep an eye on that for that Euro. Relationship between the ECB and German Constitutional Court. Keep an eye on that for relationship with the Euro. But I would, if you said to me, what's your bias? It would still be to the downside, but less so with the New Zealand dollar. Just change that back to, that's it. Okay, that's super. Thanks, Grant. Hi, Richard. I have a £1,000 account with 33:1 leverage. I only use micro lots. So does that essentially mean I'm trading without leverage? Yes, it does, Richard. So your trade size of 0.01 matches your account size of 1,000. So if you're trading 0.01 lots, that's trading without leverage. Trade size matches your account size, because the trade size of 0.01 is just is 1,000, 1,000 units of currency. A standard lot is 100,000 units of currency. So a mini lot, 0.10, is 10,000 units of currency, and a micro lot, 0.01, is 1,000 units of currency. Most of my stocks risk about 2 to 3% at the moment, but due to using dynamic stop, I'm only really risking 0.5 to 1%, barring any unexpected news story when I'm away from my desk that could wipe me out. I'm just trying to understand leverage a little bit. Yeah, okay, yeah, Richard, that sounds very healthy to me. Look, you've got an emergency stop that you're not using, and you tend to use your dynamic stop, so you're only really risking 0.5 to 1%. So, that sounds a good use of leverage, and that sounds a good use of your stops. Okay. Hi, Nick. Yeah, going back to oil, if we had a draw from inventories, why did oil sell off in the afternoon? Yeah, Nick, that was because of Fed Powell's speech. So as soon as Fed Powell gave that really, pessimistic outlook for the US, we're going to see weak growth going forward, anemic kind of income, poor income for the US, and no negative interest rates, that really hit equities. And so oil would have got dragged down with that risk-off sentiment. The thing with Nick, to remember with oil at the moment, it does get pushed and pulled around with risk-on and risk-off sentiment, but it's also got its own drivers. It's in a bit of a crisis at the moment. So, if Saudi Arabia says something as well about oil production cuts, that can move oil in itself as well. But yesterday it just got dragged around with the risk sentiment. Oh, hi, Lance. What do you make then of the spike down in oil as soon as inventories released? And then it took 4 hours for oil to finally rally, even though inventory showed the first draw for many weeks. Yeah, it's just a real mess at the moment, the oil market. So we are seeing some unusual price action going on. Why we got that funny draw, why we got that funny price action around the release, I'm not sure. But looking at the oil market as a whole, you can see that recently, it is being supported. Okay, you are seeing that support to the upside. I'm not sure, was that the release there? I think that might have been the release day. Just, you know, you found some support here at this level. So it was this level here, $19. So that's not too unusual, Lance. Finding support the 1900 and sort of rallied out of there. That's you know, that I know what you mean, that sort of spike up. It's the sellers waiting. That's what that's telling you. There's two pictures in oil. There's the short-term bullish pictures, and then there's the medium, longer term, still demand's not going to be picked up and supply still very high. So that's the push and pull. Yeah, Nick, you got it. That's it. You got it. Richard, no, that's right. Has the US dollar always traded as no? Okay, the US dollar can switch. It can trade on different things. At the moment, Richard, it's trading as a safe haven. So that's the best way to understand it. Once we're out of this, then it tends to, you know, when I say this, I mean COVID-19, then it will often move on US economic data. Okay, so it switches, it moves on different things. But the thing with the US dollar, it's tricky. It's the world's largest reserve currency. Central banks all around the world have it. And when times are bad, the dollar is your ticket out of liquidity issues. So everyone wants the US dollar in hard times. Okay, yeah, you're welcome to Shabi. Good morning, Shauna. Yeah, Shauna, good morning, Giles. In general, when monitoring commodities and equities, roughly how many pips of movement in either direction would impact or change the risk tone? Okay, Shauna, it's not a question of pips because, like, you know, at the moment, we've been seeing more pips movement impacting than normal. Okay, so it tends to be really what's happening as a group picture. So when you're looking at risk sentiment, you're looking at a number of different things. So first of all, we want to look at equity markets. So here we see equity markets are red across the board. Futures are red across the board for the US market. So that's negative. We have yields negative, right? We have a little bit of negativity coming into the oil markets. Crude's still up. Hang on, I'll go to the other chart. It's easier to read the other chart. It's just more intuitive. So you can see here, and then we look at the commodity markets. Copper prices are down, platinum's down, crude is still supported, but it's got its own drivers, and we're seeing a little bit of downside in gold and silver. So commodity markets are a little bit down. So we've got equities down, Shauna. We've got bond yields down. We've got commodities down. We want to take a look now at the currency space, and we should expect to see Australian dollar weak. Well, we know the weakness for that. New Zealand dollar weak. We know the weaknesses for that. CAD is strong. That's being buoyed up by oil, so we can understand why that currency is particularly strong. And then we should expect to see Japanese yen, Swiss franc strength, particularly Japanese yen strength, and that's broadly stronger on the day. Okay, so taking that as a whole, that's how we kind of look at risk. It's not to do with pips per se. It's to do with more, you know, movement. Now, obviously, having said that, if we're looking at equity markets, and you know, you're seeing here the S&P 500, that like if you see this short-term support level, if that suddenly falls down in the futures market, and then we break down through the Dow support level, and we break down through the Nasdaq recent support level and the DAX, then we'd know, okay, risk tone is turning more off. So it's a question of degree rather than, oh, it's at 20 pips or 30 pips. I hope some of that helps, Shauna. Okay, I'm holding pound New Zealand dollar buy from 1.0300 as medium-term trade as divergence in policy. Abu Bakr, yeah, I can understand. I can see the logic for that. The only downside with that, Abu Bakr, is that we've got reasons for weakness in the pound and the New Zealand dollar. So although that makes sense, you've got to look out. The Bank of England doesn't talk about negative interest rates. That would negate that outlook. And any negative EU trade talk would negate that outlook as well. Because remember, with the New Zealand, they're one of the quickest out of COVID-19. So they could really recover quickly. So just to be aware of that, going into that thing, I like the idea. The idea of a divergence is good. And we're looking at one divergence trade, aren't we, at the moment, the Australian New Zealand dollar. We're looking potentially at this divergence here, any retracements at 1.0700, which is a very similar similar philosophy to your trade, Abu Bakr. But the picture is still more optimistic Australian dollar, although we had that weak jobs data. So that kind of, you know, what we would really like is a strong jobs report. That would have really helped that outlook. Was the quick drop an hour ago on Australian dollar, Japanese yen because Trump said he wants negative rates on a strong dollar? No, Adam, it was most likely due to those Chinese comments, negative Chinese comments that came out, and then just would have hit equity markets a bit. And that's why we saw a little bit of risk off accelerating. Yeah, Mark, sorry. Yeah, my all trade is a daily funded bet. Based on your question, do you know what impact future prices have on that? No, I'm sorry, I don't know. If that's spread betting, I haven't done any spread betting, if that is what it is, Mark. Just check your provider. It's worth checking with them. You know, just bang out an email and find out exactly what happens. You don't want to be holding oil unsure of what happens at rollover time. So just, you know, a little bit of homework for you there, Mark, to do. Okay. Sorry, I can't be helpful and just tell you that straight away. Apologies, Mark. Yeah, Augustine, using the sentiment as a basis for looking for trades, how many trades should I really expect in a day or week? Augustine, that's a great question. Now, what you want to look at, Augustine, is just, rather than looking for how many trades in a day or a week, look for trades with highest conviction. So you want to be looking for trades with the highest conviction. Now, you know, if you've got your squawk on, Augustine, and you could catch a couple, you know, there's usually 1 or 2 opportunities a week that come out on the squawk. If you're around to get those, you know, we had you know, Saudi Arabia, production cuts, maybe a tweet from Donald Trump. Just listen out on the news squawk. And don't force it, Augustine. Don't think, you know, I'm going to go for like 2 trades a day or 1 trade a day. Only look for trades with the highest conviction. That's what you want to do, and look for the trades that. So, you know, you could be expecting anywhere between sort of, you know, 2 to 4 trades a week, roughly what you'd be expecting, Augustine. Yeah, depending on the situation. I hope that helps. Okay, I'm just going to go through, see any other questions. Just going to check here. Yeah, hi, sorry, I can't change the cursor because the cursor is set, so I can't change that. I'm sorry that's unclear for you. Hi, Danny, do supply and demand zones outweigh the news? Danny, the thing to keep you know, yourself focused on is what's driving the news. So here, for example, Danny, in the Australian dollar Japanese yen pair, you can see that we have here a supply zone. Okay, so sellers have come in from this level. Now we know that there's reasons for that supply zone, and the reasons for that supply zone are the fact that jobs data has been worse than expected out of Australia. Let's just go down. Yeah, let's just move up here. Jobs data, you know, the expected figure was 575,000, came up 594,000, nearly 600,000, and the participation rate dropped. So in other words, the employment figures are even worse than printed. So that's why we know that this demand zone, supply zone rather, we'd expect to find sellers. So Danny, what you can do, you use the supply and demand zones in conjunction with the news, because those this supply zone is a perfect place for selling now, because we have the news confirming that. I hope that's helpful for you. Okay, guys. Just want to say thank you very much for coming along. And that is the end of our session today. We've got through the questions and the chat. And thank you very much for a really good session again. I hope that's been helpful. I've been very helpful. I've enjoyed taking your questions again. They've been very good questions as per usual. So thank you very much. Oh, Adam, was that 2 to 4 trades a week from the squawk, or 2 to 4 trades total? Adam, I'd be looking for about 2 to 4 trades a total. That's what, you know, I think that's reasonable, Adam. But obviously different people are going to have different amounts of trades. Okay. Yeah, thanks, Richard. And you, yeah. Thanks, Ashley. Owen, take care now, guys. Goodbye.